I want to speak to you about how to get a personal loan without a cosigner. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? Hope you're doing fantastic. I'm doing marvelous. If you ever ask me, if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's convo, I want to give you a step-by-step on getting a personal loan without a cosigner. But before I get into the actual nitty-gritty, let me just tell you that having a cosigner on a loan is not a requirement, really. You can get a loan without a cosigner by simply applying for the loan as an individual. But the trick is you got to have a high credit score. In other words, you got to have a score of a 585, a FICO score of 585 or higher. If you have a lower score, if you have a bad score or a fair score, that's where you need someone to beef up, somebody to boost your loan application. And this is where you need to have a cosigner. And the thing here is that what is a cosigner really? A cosigner is a person who acts as the backer of another person's loan. So in your case, your cosigner will be the person who will be backing up your loan application. Will be you are the primary borrower, but the cosigner will come just to give more assurance to the lender that everything will be fine in case. So if you, the primary borrower, doesn't pay back the loan as promised and things happen, right? The cosigner will step in. So the cosigner will they must pay the lender what you, the primary borrower, owed. And so the thing here, the whole idea for a lender is if you add a cosigner to a loan, that gives the lender two potential people to collect from and two potential sources of income to fund the payments. And the person is 100%, the cosigner is 100% on the hook for the debt, just as you are. You, of course, being the primary borrower. So the whole idea, the picture I'm trying to paint here is that cosigners have responsibilities. They have rights and responsibilities. So it's very important to understand. And so you don't want to pick someone as a cosigner very lightly. The person can be a family member, a friend, or someone else, but the person has to also understand the responsibilities that come with being a cosigner, and you want to explain everything to the person. And preferably what you want to do, and this is something we've seen in our research that works a lot for people, you want to keep everything in writing, folks. Writing, you want to keep things in writing because you never know, life happens, people start forgetting stuff, and when things are complicated, things can be messy and complicated. So you don't want to have that. You want to have everything in writing and signed and notarized, okay? Now, let's talk about getting a loan with no cosigner. I'm going to give you a step-by-step. Step number one, if at first you don't get approved. So let's say if lenders tell you that you cannot get approved on your own, don't just take their word for it. Really, there are several solutions available. Some of them are faster than others if you need to get a personal loan with no cosigner. One thing you can do, and if you have the time and I would say the time and intention here, you need to work on improving your financial profile. When I'm speaking about financial profile, I'm speaking about your credit score. I'm speaking about your financial situation, your assets, your savings. Do you have a rainy day account? Do you have a savings account? Are you working? What about income? Those are elements that are very important. While by no means the quickest solution, you can increase the odds of getting a personal loan with no cosigner if you improve the metrics that lenders pay attention to, right? The metrics they use to determine your ability to repay a loan. To do so, you got to do a few things. First, you need to build credit. So if you can't get a loan with no cosigner because you have bad credit, work on improving your credit. Whether you have never had the opportunity to establish credit or you have missed payments in the past, you can always rebuild. It just takes time. It takes patience. It takes persistence. It takes time. But you know what? It's doable. Of course, for students and people under 21 years old, that's a challenge. I get that. But these individuals can try to get a small credit line or a cash secured loan from a bank to build their credit. They can even be added as an authorized user on somebody else's card. Besides building credits, you want to add income. Banks approve or deny loans based on how much of your income will be eaten up by the monthly payments, which they calculate using your debt to income ratio, your DTI. So many lenders look for a ratio of under 36%. So increasing your income through a part-time job, for example, can increase your chances of getting approved because guess what? It reduces that additional income that is coming in, reduces your debt in relation to your income. You also want to fix errors. So sometimes errors in your credit reports hold you back. So removing those errors by contacting the credit bureau that actually issued the erroneous report can help improve your credit scores. And the fourth thing you can do also is to pay down debts. Your credit score, if you really think about it, folks, I want you to picture this. Your credit score and your available monthly income are both influenced by your existing debts, right? There is a correlation here. And getting rid of debt makes it a lot easier for you to get new loans because guess what? You will not appear to be maxed out and you will have one less monthly obligation. So with important loans like home loans, rapid rescoring after paying off debt or fixing errors can result in higher credit scores within days. We have covered the topic of rescoring in other shows, specifically what Experian Credit Boost and Ultra FICO are trying to do here. So you might want to double check those shows. So step number 1, improve your financial profile. Step number 2, you want to consider other lenders. If you have been rejected by one lender, listen, doesn't matter. There are other lenders out there. You want to shop around with smaller institutions, including regional and local banks. Newer online lenders, including the P2P lenders, the peer-to-peer lenders, they are also sometimes willing to work with borrowers who have less than perfect credit. You want to explore other lenders with low score requirements. You want to pay attention to those who are very flexible in terms of their credit score requirements. There are several lenders, and folks, we have actually covered these topics on gazillions of videos, and we've seen that there are several lenders whose minimum credit score requirements are in the bad credit range, though the upper hand like 500, such as you have Avant, Freedom Plus, Lending Points, you name it. Some online lenders approve loans based on metrics beyond your credit and income, such as the degrees you earn, and these provide options for people who don't have much credit. You also want to visit credit unions in your area. That's step number 3. Because credit unions are non-for-profit institutions and they aim to have a close relationship with their customers. So for these reasons, you may have luck actually finding a personal loan with no cosigner at a credit union. Even if you have bad credit, your local credit union should be your first stop for borrowing money, especially if you have a fair or poor credit score. And credit union personal loans often have benefits over other lenders, including typically lower interest rates, right? That's kind of cool. They have more flexible terms, and loan officers are willing to consider factors beyond your credit score because guess what? They know you personally. They know you. They've seen you around. They've seen the transactional history in your account. They know how long you've been with them. They probably, they probably network with you or party with you. They have happy hours with you, so they know you personally. So this is something you have to think about, all right? Now, in choosing, one thing you have to understand, though, is that credit unions are non-for-profit financial organizations that serve members who live, study, work, or worship in a particular area. So they are controlled by members who elect volunteer board members to oversee the organization. So if you meet the credit union's requirements, you typically pay a one-time membership fee and a deposit fee of up to $25. So it's very important to understand that you got to become a member before you apply for a loan. Many credit unions offer both unsecured and secured personal loans. Both types of loans typically carry fixed rates, and the rate you'll actually get ultimately depends on your credit score, credit history, income, and debts. Step number 4, I want you to borrow less. Lenders might have denied the loan you originally applied for, but they might let you borrow less without adding a cosigner to your application. Let's say, they determine based on your DTI, your debt to income ratio, or other factors on your application that you only qualify for, let's say, for $3,000, but originally you wanted $5,000 or you wanted $10,000. Well, guess what? You want to bring back the loan amount you want, $3,000, and bingo, you get the loan approved. That's very important. I mean, you want to run some calculations to find out how different loan amounts come up. How different loan amounts fit into your budget in terms of monthly payments. And because this is how you can improve your DTI. Remember, DTI is very important. Your debt to income ratio is very critical. So making a bigger down payment on the loan can also improve your loan to value ratio and make the loan more attractive to lenders. And what is an LTV? A loan to value ratio compares the amount of the loan you are hoping to borrow against the appraised value of the property you want to buy. This is more seen in asset-backed loans such as mortgages, for example. Lenders will use the LTV to determine how risky a loan is and whether they want to approve or deny it. And it can also determine whether in the case of mortgage, whether mortgage insurance will be required. One thing I want to say here is that if you want to borrow, let's just say you want to get a personal loan. By borrowing less, you're not only increasing your chances of getting the loan approved. Guess what? You're also improving your credit score, because you'll be having outstanding balances that are lower. So that will boost your credit score, and you'll be seen as less of a risk to the lender. One thing I want to say, I want you to remember here is that lenders pay attention to three things. They pay attention to your financial situation. In other words, how much money you currently have, your net worth, your assets minus your liabilities, right? They also pay attention to your income. So how much money you're making. And the third thing that's very important also is your ability to pay the loan, to repay the loan over the duration. Those are the three things they pay attention to. So if the loan happens to be large compared to your financial situation, they might be really reluctant to approve the loan. So you might really want to think about borrowing less if you're trying to get a personal loan with no cosigner. I'll be right back. Right after this, don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. I'm still having a conversation with you today about how to get a personal loan with no cosigner. So I've given you 4 steps already. Improve your financial profile, consider other lenders, visit credit unions in your area, borrow less. The fifth thing you need to do is to pledge collateral. It's kind of important. In other words, you want to get a personal secured loan. If you need a personal loan and are willing to put up something valuable as collateral, you can get a secured personal loan. The value of the collateral reduces the lender's risk, so you should have no trouble getting approved without a cosigner and with a low credit score. You get the collateral back if you repay the loan as agreed. And the thing is that you can borrow against an asset that you own using it as a collateral. Unfortunately, this is a risky strategy. Why? Because you might actually lose the asset if you are unable to repay the loan, because the bank can take the property and sell it to get its money back. All right, let me just kind of give you an example. If you borrow against your vehicle, the bank can repossess it. Likewise, lenders can foreclose on your home if you don't keep current on your mortgage or on a home equity loan. Let's elaborate a little bit. Secured personal loans are loans that require collateral to secure the transaction. Okay, and many personal loan options are unsecured, so the lender bases your eligibility on your credit score and history. So if you don't have, say, great credit, secured personal loans are an alternative. And so what are the pros and cons here? You have to think about that because it's very important. A secured loan it actually boosts your odds of getting approved or being eligible for a personal loan with no cosigner. And you have access to a wide constellation of lenders. I'm speaking about banks, credit unions, and online lenders. You also have lower interest rates if you want to pledge collateral, because personal loans tend to have lower interest rate compared to other types of borrowing, like credit cards. Okay, and but those are the pros. The cons, and because there are risks here, you could lose your collateral, and the cashback loans could limit maximum loan amounts, and you have a fewer options compared to unsecured loans. So those are the pros and cons of pledging collateral to get a personal loan with no cosigner. Another thing you can do, step number 6, try to borrow from someone you know. Right? Think about it, because a friend or family member is less likely to care if you have a cosigner or what your credit score is, and you may be able to get a generous rate from them. Okay, so this is something you have to think about. But the question here is that before you get into the whole conversation about borrowing from someone, let's understand what's a family loan. A family loan, sometimes called an intra-family loan, is a loan between family members. And family loans are often less formal than personal loans from traditional lenders or in the peer-to-peer marketplace, which connects potential investors directly to borrowers. By contrast, family loans may have no contracts or simple contracts where the borrower or lender tracks the interest due and repayment schedule. Informal family loans may make sense for family dynamics, but a loan is still a contract, folks. It's very important. And loans have potential tax consequences for both the borrower and the lender. So a lender who charges interest will have to pay taxes on any interest earned from the borrower. And if the lender doesn't charge interest, things become more complicated, because the IRS actually requires the lender to pay taxes on something called imputed interest charges. So imputed interest is the estimated amount of interest that the IRS thinks the lender should have charged. So if keeping track of interest payments and tax implications sounds like a headache, you may be able to pay a peer-to-peer loan administrator to take care of documentation and collect payments for you. What are the pros and cons of family loans? Pros: rough credit is not an issue. There is nothing to stop family members from lending to one another, even if the borrower's credit history is a little banged up, right? Low interest rate. In some cases, family members lend to other family members at a lower interest rate than a bank would lend to them, and you have mutual benefits. So the borrower may get a loan with better than average loan terms, and any interest is paid to the family member instead of a faceless lender. What are the cons here? You have paperwork. So when you give a family loan, you may want to create a written contract that includes a promise to repay the loan. This type of contract is called a promissory note. You may also want to track interest owed, payments, and more. And you also have tax consequences. I spoke about that earlier. So when dealing with a family loan, the borrower and lender have to follow tax rules, and lenders may have to pay interest on income earned from the loan, as well as income not earned if they offer a below market rate. Unless an exception applies, borrowers may have to repay the debt as agreed or claim the canceled debt as income. What about family dynamics? So will it ruin Thanksgiving dinner if your brother still owes you the $10,000 he should have repaid by summer? Broken loan agreements can cause family tension. And another drawback here is that credit history. Unless they are reporting your loan payments to the 3 main credit bureaus, you probably would not improve your credit history with a loan from a family member. So I want to continue the conversation a little bit. When I'm speaking about family member, I'm just encompassing the larger area of loans from friends, from family members, but also from people in your entourage. All right. And when should you consider a family loan? Loans between family members can be risky. Before any money changes hands, think about putting these conditions in place. Folks, this is very important, whether you are the lender or the borrower. So you want to have loan terms. So the borrower and lender ideally should agree on a repayment schedule and an interest rate before making a loan. Loan terms should be put into a signed contract. Very important. You have legal remedies. If the borrower defaults on the loan, the lender has to decide whether to sue a family member or to absorb the financial loss. If you can't afford to lose the money, it may not make sense to lend it. And restrictions on use. For example, down payments funds from unsecured loans, including family loans, in some cases are not considered valid sources of funding for a mortgage down payments. So if a mortgage down payment is the reason for a family loan, you want to think and check the details twice. Very critical here. And I'm going to give you a few tips to make a family loan legitimate for tax purposes, because again, I spoke to you earlier about the imputed interest income. That's very important. So although a handshake between family members is an enforceable loan contract, the IRS assumes money transfers between family members are gifts unless there is proof that the lender expected to enforce the repayment terms. So you want to take a few steps to help ensure your loan is real, is the real deal in the eyes of the law. So you need to agree to a repayment schedule. All right. So rules surrounding loans between family members can become complicated if the loan agreement does not include terms of repayment. So a best practice for loans between family members is to set a repayment schedule. And what will happen here is that the borrower could actually make a payment every month or repay the loan in a few years. And you want to charge interest. So the IRS sets a minimum interest rate called the applicable federal rate. So that rate is the minimum interest rate that a lender can charge a borrower for loans over $10,000. If the lender charges less than the applicable federal rate for a loan over $10,000, the lender will have to pay taxes on foregone interest. And this is actually the interest that a lender would have earned by charging the applicable federal rate minus any interest actually payable on the loan for the period. So the minimum interest rate varies based on whether a loan is short-term, 3 years or less, mid-term, over 3 years but not over 9 years, or long-term, over 9 years loan. Okay, this is something you have to think about, and you want to put it in writing. Okay, so while a handshake technically is an enforceable loan contract, putting the repayment terms in writing gives you something concrete, showing there is an expectation that the lender will enforce the debt repayment terms. And you also want to keep records, folks. This is very important. The paperwork doesn't stop after the loan is closed. The borrower and the lender should record, they actually should record payments and keep track of the balance of the loan. Good record keeping actually will help with taxes and help keep family members on the same page. Tax rules around gifts and loans can be complicated, folks. If you are unsure of the tax implications of making a family loan, it may be worthwhile to consult a tax professional. If you're trying to get a personal loan with no cosigner, step number 7, you want to look into student loans. This could be a great option. If you're trying to get a student loan, you've got many options for borrowing without a cosigner. You want to start by applying for federal student loan programs, also known as direct loans, through your school's financial aid office. To do so, you'll need to fill out the FAFSA form and provide information about your finances. And federal student loans are the most borrower-friendly loans available. They are relatively flexible when it comes to repayment, and you might even get help paying interest costs. And so you have Stafford loans in particular may be attractive. They are available for full-time, part-time, graduate, and undergrad students. And your credit is not an issue here. So anybody can get these loans without a cosigner as long as you meet the necessary criteria for Stafford loans. For private student loans, it's best to start borrowing with federal student loans. If you need more than the maximum allowed, you also can borrow from private lenders. And private lenders are much more likely to require a cosigner unless you have sufficient credit and income. But that's not always the case though, and you might have income and credit as a graduate student. So it's worth considering if you are determined to get a personal loan with no cosigner. It's all about your situation. It's all about what you really want here. And step number 8, if you want to get a personal loan with no cosigner, I mean, this does not really relate to loans, but it kind of. You want to consider credit cards. Why not? Because if the amount you want to borrow is small, you could potentially borrow on a credit card instead. But this works best if you already have a card with a decent APR and a suitable credit limit. If you don't already have a card and you do currently have bad credit, the options aren't really great. Unsecured credit cards for bad credit tend to come with high rates and fees. And with a secured card, you'll have to put down a 200 plus security deposit, which becomes your credit limit. So that kind of defeats the whole purpose, right? For someone interested in getting a loan in the first place. So yeah, you want to go with credit cards only if you have a decent APR and a suitable credit limit. All right, folks, this was it for today's conversation. I was speaking to you about how to get a personal loan with no cosigner, and I gave you 8 steps. Number 1, improve your financial profile. Number 2, you want to consider other lenders. Number 3, you want to visit credit unions in your area. Number 4, you want to borrow less. Number 5, you want to pledge collateral. Number 6, you want to borrow from someone you know. Number 7, you want to look into student loans. And number 8, you want to consider credit cards. Thank you so much for your attention. I really appreciate it. I will speak to you another time. But until then, remember, stay marvelous.